When people notice that food is more expensive, rent is higher, fuel costs more, and assets like gold, silver, stocks, and real estate are all rising together, the natural question is, why is everything going up at the same time? Many assume it's supply shortages, corporate greed, or temporary shocks, but history tells us something deeper. When everything gets more expensive at once, the problem is rarely the goods themselves. The problem is the currency used to price them. Take simple examples. If silver moves from $25 to $40, gold from $1,800 to $2,400, oil from $60 to $100, and the average home price jumps from $300,000 to $420,000, it looks like a boom. But did all these things suddenly become more useful overnight? Or is the dollar buying less than it used to? Prices don't rise together by accident. They rise together when the measuring stick, the dollar, is being stretched. In every major debt cycle, governments borrow heavily to maintain growth and stability. When debt grows faster than income, policymakers face a choice: allow painful deleveraging or print money to ease the burden. History shows they almost always choose the second option. More dollars enter the system, but the amount of real goods doesn't rise at the same pace. The result isn't immediate collapse, it's gradual price inflation. You don't see the dollar crash, you feel it at the grocery store. People often argue the dollar is strong compared to other currencies. That may be true on a relative basis, but strength against weaker currencies doesn't mean strength against real purchasing power. If your salary rises from $50,000 to $55,000, but rent rises from $1,200 to $1,800, groceries from $300 to $450, and energy bills from $150 to $300, you're not richer, you're falling behind. The numbers are bigger, but the value is smaller. This is why extreme price targets shouldn't be dismissed too quickly. When people hear ideas like $500 silver or $3,500 gold, they react emotionally. But those numbers don't necessarily describe stronger metals. They describe weaker money. Gold at $35 once sounded permanent, then it became $800. Silver at $5 felt expensive, then it touched $50. These weren't fantasies, they were reflections of monetary stress. When everything becomes more expensive at once, markets are sending a message. Confidence in money is changing. Assets that cannot be printed reprice first. Cash holders lose quietly, while asset holders appear to win, even though the real game is about preservation, not profit. The mistake people make is focusing on price movement instead of what the price movement represents. So the real question isn't why prices are rising. The real question is what's happening to the dollar beneath the surface. Because when money loses credibility, prices don't just rise, they reveal the truth. And history shows that once this process starts, it rarely stops quickly or painlessly. They look at rising prices and assume opportunity. They hear that silver could go to $100, $300, or even $500, and they think in terms of profit. But in macro history, extreme price levels are not rewards, they are warnings. When a currency weakens, prices don't rise in isolation, they rise as part of a systemic adjustment. The market is not celebrating, it is compensating. Consider what happens when interest rates fail to keep up with inflation. If inflation runs at 6 to 7%, but savings accounts yield 2 to 3%, holding dollars guarantees a loss in real terms. Over 10 years, that erosion becomes enormous. A dollar saved today quietly buys much less tomorrow. That's why money moves into assets, not because people are greedy, but because the system forces their hand. This is also why prices of very different things begin to move together. Technology stocks, farmland, copper, silver, housing, these assets have little in common operationally, yet they rise in the same periods. That tells us the driver isn't innovation or demand alone, it's monetary pressure. The dollar is absorbing stress from debt, deficits, and policy choices, and prices adjust to reflect that stress. Look at history again. In the late stages of past empires, governments expanded money supply to sustain growth and fund obligations. Short-term stability was preserved, but long-term purchasing power was sacrificed. Citizens didn't see their currency fail overnight. Instead, they experienced a slow, confusing decline in what money could buy. Wages rose, prices rose faster, savings lost meaning. This creates a dangerous illusion. Nominal wealth increases while real wealth stagnates. Someone may feel richer because their portfolio grows from $100,000 to $180,000, but if the cost of housing, healthcare, education, and energy doubles, the improvement is mostly on paper. The numbers look impressive, but the reality feels tighter. And this is why focusing only on prices without context leads to poor decisions. When silver rises sharply or when assets hit record highs, the key question isn't how high can it go? The better question is, what conditions made this move necessary? Because markets don't reprice without reason. They reprice when confidence shifts. When everything gets more expensive at once, it's not a coincidence, and it's not temporary noise. It's the system telling you that the currency measuring value is under pressure. The dollar doesn't collapse loudly, it erodes quietly. And by the time the warning becomes obvious, the adjustment is already well underway. That's why understanding money matters more than predicting prices. Prices are symptoms, the dollar is the cause. And history shows that those who recognize this distinction early don't panic when numbers rise. They understand what the numbers are really saying. Instead of reacting emotionally to price movements, you start reading them as signals. When silver jumps from $22 to $35 in a short period, or gold pushes past $2,000, or everyday expenses rise month after month, these are not random events. They are the system adjusting to pressure. Markets are forward-looking. They price in stress long before it becomes obvious in headlines or official data. This is also why official explanations feel unsatisfying. You're told inflation is transitory, or that prices are rising to temporary factors, yet years pass and prices don't return to old levels. A meal that once cost $8 now costs $15. Rent that was $900 becomes $1,500. These prices don't come back down because the currency itself has changed. Money, once expanded, is rarely contracted without causing pain, and policymakers avoid pain whenever possible. As debt grows larger, the system becomes more sensitive. Governments must refinance old obligations while funding new ones. Higher interest rates make this harder, not easier. This creates pressure to keep rates lower than inflation for longer periods. The result is a slow transfer of value from savers to borrowers, from cash holders to asset holders. It's subtle, but it's powerful. This environment also explains why people feel confused. They're told the economy is growing, yet life feels more expensive. They're told markets are strong, yet financial anxiety increases. That contradiction exists because growth measured in dollars isn't the same as growth measured in purchasing power. When money weakens, nominal growth can hide real decline. Understanding this helps explain why silver in particular behaves the way it does. Silver is both a monetary metal and an industrial one. It reacts to inflation fears and economic stress at the same time. When confidence in money weakens, silver doesn't wait for confirmation, it moves early. Not because it predicts the future perfectly, but because it responds to pressure faster than most assets. If silver were to reach numbers like $100 or $200, it wouldn't be proof of prosperity, it would be evidence of imbalance. The same would be true for homes priced at $1 million that once sold for $300,000, or stocks trading at valuations disconnected from earnings. Big numbers are not signs of health, they're reflections of distortion. The real risk for individuals is misunderstanding the message. Chasing prices without understanding why they're rising often leads to poor timing and false confidence. The goal isn't to celebrate inflationary gains, it's to recognize what kind of world produces them. In those worlds, preservation of purchasing power matters more than chasing returns. So when everything gets more expensive at once, don't ask which asset is the best trade. Ask what the system is trying to tell you, because prices speak the language of stress before policymakers do, and the dollar, quietly and persistently, tells the story underneath it all.